Welcome to Framework Fortune. I'm your host Ben, and in this video I'm going to go over the things you need to know before you ever make a day trade. Okay, this is going to be somewhat of a beginner's guide, but it's going to be the things that you have to know. You need to understand them before you ever click that buy button. If you don't understand them and you are trading right now, you are going to lose money, okay? I don't care if you've gotten lucky on your first couple of trades and made some money. If you don't understand why you made money, you're not going to be consistent and be able to keep up those profits. You're not going to keep getting lucky. So you have to understand all this. So I'm going to go over everything. It's not going to be a huge amount of detail on every subject, but I'm going to go through them and explain them. And if this video gets 100 likes, then I will do a live Q&A outside of day trading hours so I can focus solely on questions. So let's dive into it. The first thing that you need to understand before you make a trade is volume. This is one of the most important things for day traders, okay? If you are trading a stock that does not have volume, you are trading a bad stock. You should not be in that stock, okay? What is volume? Volume is amount of shares bought and sold during a time period. So, volume is people. People are the ones buying and selling the stocks. Nothing else in the stock market moves stocks except for people. People are the only thing. So volume equals people buying and selling, right? Volume is also your demand because the people are buying and selling the stock. So if the stock market is supply and demand, the amount of shares available to the public, the shares that you buy as a trader, is your supply. Volume, the people, are the demand. So that's very important. I'm going to go over some examples of stocks that you don't want to trade. This stock, for instance, you see this chart? Bunch of white checks, not much going on. You look down here at the bottom of your volume bars, you can see this is 5,000 shares of volume, okay? It got to 5,000 right there, and then in this volume bar, it got a little over 5,000. That's not a lot of volume on a stock. You can see over here, I have it on my side table, 46,000 shares in volume today on this stock, and it's currently after market hours, and it's only had 46,000. If a stock looks like that, you do not want to trade it. I don't care if it has the best press release. I don't care what circumstance that you think you should trade it. Do not trade it. This is a very illiquid stock, which means you're not going to be able to buy and sell into it with ease. As day traders, we're trying to get in and out of stocks very fast, sometimes extremely quick in a matter of seconds, depending on your strategy. So if there's no volume, if nobody's buying and selling the stock, then it's not going to do anything. Okay, and it's going to be very hard to get in and out of it. So don't want any stocks like this. Okay, this is another example of very low volume. But you can see this chart pattern right here is very, very special. As you can see straight across here, all the tops of these candles are almost perfect, or they are perfect. And the bottoms as well. It looks like a barcode. If you go pick up a bag of chips and you look at the barcode on the back, it's going to look exactly like this. Stay away from these stocks. Remember, people move stocks. If people are moving stocks, everybody's different. There's so many different characteristics and qualities of every person. They have their weaks and their strengths. Stock movements are not going to be exactly perfect. This is perfect movement. So the only thing that can explain this is it must be made by something that doesn't really make mistakes or have any emotion. A robot. This is traded by an algorithm. There's no volume from people buying this stock. only an algorithm. So you don't want to trade these, okay? You see this? You never want to trade these. I don't care what the circumstance is. You can have the best press release. You trade this, you're trading against a computer that's smarter than you. I'm sorry to say it, whether, you might have a huge IQ, but a computer is going to be smarter than you because it doesn't have any emotions. And there's a very big thing in day trading is you have to keep your emotions in check. It's one of the hardest things to do, and computers can do it without any effort whatsoever. So you will lose if you trade against computer algorithms. Okay, maybe you can find some kind of patterns or something, who knows? But from what I've seen, you will lose if you trade any stock that looks like a barcode. So take those right off the table. As soon as you see them, take them right off your watch list, pay them no attention, just get them out of there, okay? We want stocks that look like this. This is what we want to trade, okay? I've got this pushed back in pre-market on my chart here, and I'm going to go over and go through it, but you can see this is a nicer movement, and if we slide over here, this is nice. We got nice fluid movements, right? You see it's kind of flowing like an ocean or something like that, like a stream. You got this nice fluid motion. That's people buying and selling the stocks, okay? That's people buying and selling the stocks. They're moving the stock in this fluid motion. So if you buy here, you can sell anywhere and get out of this stock. If you buy here, you can sell and get out of this stock at any time. Like, there's not going to be any issues getting out of this stock. If we look at the volume for the day, 358 million shares. Okay, that's a lot of shares traded. That's a whole lot. That's what you want. You want to find that volume. Now, in the morning in pre-market, this stock at this point here had a lot of volume. You look down here at the volume bars, you can see on the side it says millions. So this 1 stands for 1 million. So just in the span from 7:30 to 8:30 before market opened, you can see there was millions of shares traded through that time. So in pre-market, this would be one to put on your watch list, right? It's got volume. So when you do your scans, you only want to look at the stocks that have volume. Okay, you can save a lot of time by only looking at stocks with the most amount of volume, stocks within millions of volume in the morning. That's where you want to be at, because that's where all the other traders are looking at. That's where the retail traders, where the professional traders, where everybody's going to be at. They're going to be looking at the stocks with the most volume because they're the easiest to get in and out of. And with more volume means more people buying it, so the price is more likely to go up. A lot of volume, you have better chances of big spikes. So volume is very important. The next thing is support and resistance. I cannot stress how important it is that you know how support and resistance works and what it is and how to spot it, how to draw it on your chart. You need to know support and resistance. If you're trading without knowing support and resistance, you are trading blind. You are gambling. So what is support and resistance? Support and resistance are price levels where a lot of buyers or a lot of sellers could come in at. So it's an area that is either going to hold a price of a stock up, that's your support, or it's an area where a lot of sellers are going to come in and try to push the stock price down. That's your resistance. So basically, support is a floor, resistance is your ceiling. You need to know where these zones are, because when you're in a trade, if the price is going up, if you know where resistance lines are, you'll know where you need to start locking in profit at. Or if it can't break a resistance area, you know you need to lock in all your profit right there. And when it comes to entries, you need to know where support is. If you're buying at an area that doesn't have any support below it, then you're buying at a very risky area. That means there's not going to be any floor to hold that stock price up if sellers start to come in for some reason. So you're taking a very risky trade by not having any support below your entry. So it's very important for your entries and exits in the stocks to understand support and resistance. And we'll go through and I'll show you how to find the different areas of support and resistance. So in the stock market, because it's human beings, because it's people who move stocks, every 25 cents is going to be a natural support and resistance line. Why is that? Because people are not that great at math, right? There's a lot of people who are really good at math, but it's a lot easier to add 25 cents plus 25 cents than it is to add 26 cents and 32 cents. Like, you can do the math, but you know right off the bat without hardly even thinking that 25 plus 25 is 50. So every 25 cents, when traders are doing math in their head, they're going to think, is this a good place to lock out? If there's a resistance area there that's outside of just the 25 cent area, which I'll show you the other resistance areas in a second, then there's going to be a hard time for it to break there. Traders are going to sell, most likely, every 25 cents because it's easy math to do. So you have natural support and resistance every 25 cents. Now, this is not always that strong. So the support can break real easy and the resistance can hold up really strong. So you have to understand that. If you see natural support and resistance areas with past chart history support and resistance, then that area is probably going to be pretty strong. It's either going to be really strong support or really strong resistance, because then you have twice the amount of support or resistance in that area. So what is past chart history? Well, we're going to look back here. This is the yearly chart. It's a daily chart, but 1 year, and each candle represents 1 day. So where we find these support and resistances on these old charts on the back of the chart here is where multiple candles touch. So we look back here, and we can see this red candle here dropped down, but there's not too many candles straight across where that touches, but there is a few right through here. So we could say that's one area of support. You just draw your line there. So you see this candle drop down. I'll even blow it up so you can see it even closer. Okay, this red candle sold off, dropped to here, it bounced back up. All right, now we didn't touch this line again till right here. You can see both of these candles, the bodies held up as some support, right? The stock didn't crash below this until right here. And then it got back above it. You see it bounced off again. Did the same thing here. It bounced off again. So we see it bounce 1, 2, 3, 4 times. 4 times right through there, we see this bounce off of this line. So we know that 155 area is some support. And if we go across, and actually right here too, the tops of these candles hit that support. So now that support became resistance right through here. Because old support becomes new resistance. If the stock drops below the support level, that support level will then turn into a resistance line. It'll be a lot of sellers coming in there to try to push it down to hold it below that line. So it becomes resistance. Same thing with old resistance. So if you have old resistance, like right across here, that can become new support. So old resistance becomes new support. Old support becomes new resistance. But we can see right here where these candles hit that old support line, that became new resistance. So we go, there's nothing going on anywhere near here until over here. So you can see it started coming up close to that support line. Well, every 25 cents we know is an area of support or resistance. So we can draw the line at 150, and you can see kind of double support there. That candle came up close to the 150 area, and this one right here came a little close. But when it broke through that resistance, that old support that became new resistance, it moved all the way up. So you got a nice breaker resistance there. But that's not all the support and resistance on the chart. There's other areas, right? So you want to map out all these areas. So you see right across here, right in this area, right in this $2 area, you had several candles that hit here. One candle hit right here. This one hit right here. This one hit right here. So that area was some resistance. It hit 3 times. We go back across to the other side of the chart, and you can see that resistance that was on the back of the chart back here held up as support on this candle. See, this one candle dropped down to that old resistance, and it held up as support, and then the stock moved up. So you can look anywhere, because there's more support and resistance down here. Like at this point, the stock's way up here, so you wouldn't really need to map out your support and resistance way down here, but you still can. You can see this low is 28 cents. That's the lowest it's ever been, right? So that's going to be some type of support, because it's never been that low, at least not in a year. And you see it got kind of close to that area right through here. It didn't get down there, but it built more support right across here in that area there. And if you look back, that line keeps going, and there's some other areas where those candles hit at. See that candle there popped back above that line, held up, and then the next day it cracked, and then that line became resistance. This candle hit there, this candle hit there, and then these couple of candles hit there as well. So like I said, if you've got a chart that looks something like this, and the price is way up here somewhere, you really don't need to draw support and resistance for down here. It's not really a reason to, because most likely in one day the price is not going to go from $4 if this opens tomorrow around that area, $3.29. It's most likely not going to open up tomorrow at 78 cents unless something dramatic happens, like a common offering or something like that. So that's going to be your past chart, support, and resistance. So we have natural, and we have past chart. Now if we look, that's on our daily chart, our 1 year daily chart. If we look here, this is the 5-minute chart, we can see lines of support and resistance on here. So look at where these candles are at. So you see this candle hit right here. This was a pivot point, and a pivot point is where the stock is going up or down. It hits a price area, support and resistance area, and then pivots and goes the opposite direction. So we know that pivot point is some resistance. So in pre-market, you could have drew a resistance line right here, and you would have known when this comes up, it hit right there 1, 2, 3, 4 times before it broke. That held up as some resistance, that pivot point. So we know there's resistance there. Now where's some support at? If we're looking back here at the pre-market chart, you can draw a line. You can see the stock dipped down there for a second and dipped below it, but it popped back up, and then it held right here and did a little move, and then it bounced right off of here again, a little move, bounced off here again, went up, and then this morning after market open it came down and it bounced off again. It didn't quite get down there, but it was close. I mean, you're talking about a 5-cent difference, but it was real close to that support area. And when it pushed down, buyers came in and pushed it back up, and then you get this nice run up into this resistance and it breaks. But there's more support. Okay, there's even better support. Draw your line right across the top of these candles. See this candle hit here, this candle hit there, this candle hit, this candle hit, this candle hit. Like, look at all these candles right across here that hit this line. So we know that area is some resistance. And you see there, it hit it again, resistance. Hit it again, and this time it broke over it. But it got held up at next resistance. And then you see right there, it held up as some support. It did crack below it a little bit, but it ended up holding. This ended up as some support, and it bounced off of there and kept going. So what is this right here? This is another pivot point. See, the stock went up, hit this area, went back down. So that's a pivot point. We draw this straight across, and we can see it did that move where it hit and came back down, and then it came back up, hit again, came back down, and then it came back up again, hit this resistance again, and it broke over this resistance. Now what do we got? Another pivot point, right? See that? Stock pushed up after it broke this resistance, hit this resistance, made a pivot point, and then it falls off. And you can see this line right here, this line that was old resistance back through here, held up as support here, here, and here. Okay, so that's your chart history on the 5-minute and on the daily. You know, natural support and resistance. And then we also have moving average support and resistance. And the moving averages I have on this chart. You can see those pretty clearly. These lines, that's what these different colored lines are. And they're just moving averages. But if you look at it, you can see where they acted as some support and resistance in places of the stock. So right here is a good example. You see it pushed up. It got held up right there at the yellow line. That's the 100-day moving average. This candle held up there. This candle held up there. All right, so that was resistance. It broke above and it hit this red one. That red moving average is some resistance. That's the 200-day moving average. So that's the moving average over the past 200 days. So that's a lot of information. And if the stock is getting stuck there, then that's probably going to be some strong resistance. It did break through, but it broke through very momentarily and dropped back down. And you can see that candle bounced off of the yellow moving average, the 100 moving average. And then it kind of got hung up in this little area, but this area held up as some support for a little bit. It was trying, and then it cracked. You see it drops down. And then when it gets back above all these, they hold up as some support. And you can see this green one here, which is the 13-day or the 9. You can use either one. They're both pretty similar. But you can see it started coming up, and it actually bounced off of the moving average there on this big green candle. Because it came down and touched it, and then bounced off. So where the stock price is right now, it closed up here at 329. It's actually currently at 345, but it closed at 329 on the body of the candle. It's a little ways away from that moving average. So that moving average support is pretty far down there. And moving averages tend to act like a magnet. If a stock gets way above a moving average like this, at some point it's going to want to meet back with that moving average. And you can see it on the 5-minute as well. This stock was sitting here bouncing right off this moving average. This is the 13. See, it's bouncing right off of it. Gets way off of it. Pivot point hits, pulls back down, bounces off the moving average again. Hits the same pivot point right here, comes back down, bounces off the moving average again. So these moving averages can be support and resistance at angles. Your chart history and your natural are all going to be parallel lines for support and resistance. Moving average support and resistance is going to be according to the moving average. So they can constantly move up, or they can constantly move down or sideways. But that's all your support and resistance. You need to understand all those and understand the power of those and what they're telling you. They're telling you a lot of information. So far, by knowing volume, by knowing support and resistance, we're a little bit ahead of the game compared to most of the retail traders. All right, so our next topic that you need to know are candles and price action. So we're going to start with candles, and then we'll incorporate price action as we're talking about the candles. So if you don't know what a candle is, each one of these are candles. Okay? Candles represent the price movement in a time period. So this is a 5-minute chart. So each candle is going to represent the price movement in a 5-minute period. Okay? And price action is the price movements within a time period. And you have to understand price action of how a stock is moving to kind of understand which way it's going to go. As traders, we never know if a stock is going to go up or down. Okay? It can do one of the two. It can go up, it can go down. So there's a 50-50 shot at calling it. If you've been in other live stream chats or other chats and you hear a trader saying, I know this is going to happen, I know this is going to happen, and then you see the stock start to do what they say they know is going to happen, and then all of a sudden it just dumps on them, that's because we can't know. There's not a guru, there's not a master, there's nobody who knows for sure, 100% without a doubt, that a stock is going to do what we think it's going to do. At any time, all it takes is one person to ruin the party, okay? You have to keep that in mind. There are traders out there, professional traders, okay? They're on Wall Street, they're in the pits trading, they're trading with a lot more money than most of us retail traders, okay? If one of them decide that they want to bring a price of a stock down because they think it's too high and they're trying to fill a position, a giant position, because you can't just buy 1 million shares in a stock, okay? You have to buy it in increments. If you go and buy $1 million worth of stock or 1 million shares worth of a stock, depending on the price, and you hit buy market, the stock is going to shoot up quite a bit, and then it's going to dump because all the retail traders and other professional traders who were holding it are going to lock in their profits. For some reason, this stock just shot to the moon for not really a good reason, and that stock's going to dump. So if you had 1 million share position, you're not going to be able to get out. You're actually going to destroy yourself. So they have to buy in small positions. And if they decide that a price is getting too high and they're trying to fill that position, that one trader can come in and put a wall of sell orders, okay, or a wall of short orders at a resistance line, and you're going to have a hard time pushing it up over that. Retail traders are not going to be able to take that out. If one person, just one person, decides that they don't like the way it's moving and they have the power to change the movement of the stock, that can happen. So as traders, we have to realize this. No matter how much we think something is going to happen, the opposite can happen. And that's why you have to understand the price movements of a stock. You have to understand that price action. But back to candles, there's two parts of a candle. There's this middle part, the body, and then these little thin parts, which are called the wicks. Okay, and I have a whole video on candlesticks explaining them. It's in the day trading playlist. You can go check that out. But basically, candles open and close because each candle represents a time period. So where does it open in a 5-minute time period? Well, on a green candle, the open is going to be at the bottom of the body, right? Because green means good, green means up. So the open is going to be at the bottom. So this candle right here, this big green one, opened up right here at 313. And then it pushed down. Sellers tried to push it down, and then buyers came in and bought it up, pushed it back over the open. It shot up here. Sellers pushed it down, so you get this little thin wicks. And then it closes right here at the top of the body. So on the opposite side, on the reverse, on a red candle, the open is at the top, right? Red is bad, red is down. So the open at that time frame is going to be at the top of the body. So this opened here at 341. Buyers came in, pushed it up. Seller said no, 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 pushed it back down. And you have a little bit of a dip right there, this little tiny wick, and it came back up and it closed right there. So by understanding that, you can tell who's got control of the stock, and this is also part of understanding price action. So if we're looking at that, buyers had control of this all the way up to here, and the seller said no. So on this candle, when it pushes up, and we see that it tries to push up and sellers start coming in, and then it starts going back down. It's going at this point right here, it's past the close of this green candle. So all this momentum you got from opening here and pushing up, sellers started pushing it down, and it dropped below that momentum there. So now you know it's going to probably keep coming back down, and you see it kept coming back down. So you got to understand who's in control of the stock. So at that moment, right through here, you can see sellers had control of it again. And then it came to support on this moving average, and buyers came back in and took over, okay, and pushed it back up. So that's why support and resistance is important, and we draw the lines, we can see the moving average support is there and this support from right here. See, this candle came up, hit there. This candle came up, hit there. This one came down, bounced off, and it came down, ended up holding again. So when we see this support hold on this candle, and we see this close right here, and the next candle open up and it pushes over this red downward momentum, now we know the momentum has changed, because you got it's pushing down, right? And then it bounces, comes back up. As it gets right above the open of the red candle, now that momentum's changed and the stock is pushing up. So that's the price action we got to understand. And we can look at this on a bigger level too. That's just looking at those few little small areas. We bring the stock back, we can see who has had control over this stock the last couple of days. So back here it's just going sideways, but then it started coming up, right? You can see all this upward movement. So buyers had control of this. They wanted to keep pushing this up, right? People are still buying it. That's what you want to look for. If people are buying the stock and it's going up, that's a good thing. You want people buying it. You want the price moving up. If we look at something on the opposite, you can see here on this stock, it went sideways, had a push up, but then it started coming back down. And if we draw a line from here, right across the tops of these candles, you see it hit there at that pivot point, it hit there, and it hit there. So you can draw this line down, and you see this line is pointing down. So this stock at this moment, from here to here, sellers had control of it. Buyers tried to take control of it. As you can see, it pushed up there because it bounced off a support line. Buyers came in at that support. That support held up, so it pushed up. But it couldn't keep pushing up because of the selling pressure. So while this is in this downtrend, while it's pointing down, you know the odds of this stock going on a big rip are pretty small. Most of the time when stocks are in a downtrend like this, they keep selling off. You can see this downtrend lasted pretty much all day until right here, almost at the end of market close. So until it broke over that, it really had no chance of getting back up to this $5 high. And we can tell that, we can say the probability of the stock going up is not very good until it's above this downtrend. And this is a perfect example on this candle right here why you have to wait for confirmation, because in this 5-minute candle it did break above the downtrend for a few minutes maybe, or a minute, but sellers pushed it all the way back down below this downtrend line. The stock closed right there at the bottom of the candle. And that's pretty much a fake out trend reversal on that one candle. That's why you have to wait for confirmation. You need to see it break above the downtrend and then hold above the downtrend, and then you can start getting that move back up. So we know that whole time sellers had control of it, right? IDEX, but you can see right there all these candles touching, bam, 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 bam. They all bounced off of this uptrend. So the general direction of this stock was up. So you know the odds of this stock going up are probably pretty good because it's been going up. Right? It's pretty simple. Price action can be very complicated if you make it complicated, but simply enough, if you look at it, which direction is the stock heading? So the next thing I want to talk about, we went over volume, we went over support and resistance, we went over price action and candles. So the next thing I want to talk about, because I get this a lot in the live stream chats, is market order or limit order. People don't know the difference. If you are trading and you do not know the difference between a market order or a limit order, you're going to have some issues, okay? You have to understand how these orders work to be able to use them properly. And there is other orders that you can use, trailing stops and stop losses and all that, and you can figure that out. You can Google that or look on Investopedia if you want to learn about all the different orders. But the two main most important ones that most traders use, and you can use without having to know the other ones really and still be successful, is limit orders and market orders. So what is a limit order? Okay, a limit order will guarantee the price of the stock. So for example, let's say we're trading IDEX, and when this breaks 305, when it breaks this resistance line, we want to put a limit order in at 305, okay, because we want to get filled at 305 at the break of that resistance, or 306. Well, that price will be guaranteed. So that's where the order will be filled at, okay? But limit orders do not guarantee the order will get filled. So you're guaranteed to get your $3.05 price, but you're not guaranteed that the order will actually go through. So if it does go through, you'll get it at 305, but if it doesn't go through, oh well, you didn't get it. So we put a limit order in there, and let's say the stock really shoots up really fast and there's not enough shares to fill your limit order at 305. So there's only one seller at 305 and somebody else's limit order got filled with that seller's shares. Now there's not a seller at 305. The stock price is going to be at 306 and you didn't get filled because limit orders are not guaranteed. A market order guarantees that you will get filled. No matter what, if you hit buy with a market order, you will be in that stock. It doesn't guarantee the price. So where limit orders guarantee the price, market orders do not. But they do guarantee the fill. So if your idea is to get in and to break at 305 and you hit buy market at 305, you might get filled at 320 or 315. Depending on how fast the stock is moving, you can get filled higher up than your target price. So you might want to get filled at 305, but you might get filled at 310. But you did get filled. You are in the stock. So when you're trading, depending on your strategy, will depend on what type of orders you want to use. Most of the time, if you're looking for bounce plays like this one here, say you see us run up like this, hits this pivot point, this resistance area, drops back down, and you think this area is going to hold up as support, then you can put your limit order right there at 305 when the stock's way back up here, and you just wait till it comes down and you get filled, and then you can sell whenever you feel like it up through here, whenever you feel as your price target has been hit. So that is a case to use a limit order. A market order is usually for momentum traders. So momentum traders are trying to get in the stock while the stock is going up. So you see the stock was moving up here. So back here we see it drop down at open and then push up. And then this next candle here starts pushing up. You might want to be getting in this because the possibility of it ripping might be pretty good. So you mark it in and you're filled. You may be filled up a little higher, like maybe in this area at that 297 instead of down here at 284 where you tried to get in at, but you're in it, and that way you do catch some of the profit on the way up. And it's also good to use market orders when you're getting out of a stock if you're not a fan of limit orders or if your strategy it doesn't really require limit orders. So it's very important to know the difference of both and how you can use them. So the last thing we're going to talk about is a reason to trade a stock. And this can translate into long-term investing and swing trading as well. No matter what, you have to have a reason. And not just any reason. You have to have a good reason to buy a stock. Okay? Doesn't matter whether you, like I said, day trading, swing trading, long-term investing, doesn't matter. You have to have a good reason to buy a stock. Pharmaceutical stocks might be hot, but that doesn't mean you can buy any random pharmaceutical stock. Okay, the medical industry is a big industry. There's a lot of different types of medicines and treatments and surgeries. So if, say, coronavirus stocks have been hot, the stocks that are talking about possible vaccines and treatments, then you're going to want to look for those same similar companies. And you still don't want to buy yet, but you want to look for those similar companies or those same companies. You don't want to be looking for coronavirus stocks in, say, a dentistry stock or a cancer stock. If it's a company that's trying to come up with a cure for cancer, the odds are that they're not going to have any type of cure or treatment for coronavirus. So you can't just say pharmaceutical stocks are hot, I'm going to buy random pharmaceutical stocks. That's not a good reason. You need to have good reasons, okay? So what are good reasons to buy a stock? Well, one, it's very important we know volume. If there's no volume, don't waste your time. Got to have volume, right? Same thing with long-term investing. If a stock never has any volume, if you have an emergency and need to pull some funds out of your portfolio and you're in stocks that don't have any volume and you can't get your stock to sell because nobody's there to buy your shares, then that's going to be an issue. So even with your portfolio, you need stocks with volume. So volume is one reason. It can be a good reason, but you also probably want more than just volume. So IDEX had volume. What else did it have? It had some PR. It had a press release, right? You can see right there, they got $3.2 million in orders from China. Okay, if China's buying their products, that's probably a good thing, right? They're getting money, so you need positive press releases. So you have volume and you have a positive press release. That's two good reasons right there to possibly buy this stock. Now, as far as day trading, you really need a third reason, because you just buy a stock because it has volume and a press release, it may not go up. And we can look at that on EVOC. You know, it did go up back here, but at market open, it sold off. I guarantee a lot of retail traders thought right here when it started coming back up, after this little sell-off, they thought at market open, it was going to push up and break over this 505 and just run to the moon. It did have volume. You see it had 39 million shares in volume today. It did have a good press release. We look at it, you see they got the FDA nod for their drug. That's a good thing. The FDA saying, good job on your drug. You're probably going to get approval. They may even got approval. I haven't looked all through the press releases yet, but still, it's good PR, good volume. The stock did go up. It was in an upward movement, but throughout the day, it sold off. So just having those two reasons still are not good enough to buy this stock. So what do we got to look for? We have to look for another reason. And the reason would be, is the stock going to continue up? We see it open, pushes up. We got to wait, kind of figure out, is this going to keep pushing up or not? So right here, you still wouldn't want to buy because you don't know. So you're waiting, comes back down, and you see it starts breaking support lines. Support line there, it broke. Dropped down some more, broke this support line. Went sideways for a while, dropped and broke this support line. So it's being sold off, right? We have this downtrend, like I was talking about earlier. So we have two good reasons, but we have one reason not to trade this stock. The stock is pointing down, so even though it's got volume and it's got good PR, it's still in a downtrend. So that's a reason not to trade the stock until it gets back above that downtrend. So you need good reasons. And having one or two reasons is not always enough to buy a stock. Now, you still have to have a strategy for all this, though. If you do have three reasons to get into the stock, if you don't have a strategy, then you're just kind of randomly buying and selling it. So you need to have a strategy as well. And there was multiple strategies that could have been used to trade IDEX. And you could have scalped it. You could have got dip buys, bounce plays. You could have shorted right here. Like, there's a lot of different ways to make money in the market. So you have to incorporate all this. You have to incorporate volume. You have to incorporate support and resistance. You have to incorporate strategies. You have to incorporate candles and price action. You have to incorporate reasons. Like, you have to look at the whole entire picture. And then you're going to use all your tools like the time and sales and level 2 and your charts and your indicators, your moving averages, to help give you information about the picture. We're basically putting puzzles together. All right? If you've ever put a puzzle together, you know there's a bunch of little pieces. And we're trying to find the bigger picture to get a clear picture of the probability of the stock is going up or down. So we got to put all these little pieces together, and then we get the picture. Then we're seeing clearly how we need to trade the stock market. That's why all this is important. That's why if you don't understand any little bit of this that I've said throughout this video, you need to learn it and understand it so you can put the pieces of the puzzle together. If you don't know how the pieces of the puzzle go together, then it's not going to come out a pretty picture, is it? You're going to have a puzzle that looks like some type of Slimer thing off of Ghostbuster that has no shape and no clear picture and no form. And you're going to lose money. So you got to have all these under your belt, fully understanding them to be a consistent, profitable trader. So I hope this video helped you guys out a lot. As I said, this video gets to 100 likes. I will do a Q&A, so if there was something you didn't understand, write the question down. Keep sharing this video till we get 100 likes, and then I'll do the Q&A, and I will take all the time that I possibly can before my throat runs dry and I can't talk anymore to help you guys understand this stuff. Okay, because it seems like a lot, but if you learn it in pieces and then put it all together in one big picture, it'll all work out. So that's it for this video. If you haven't yet, go ahead and hit that subscribe button if you want to learn more. I'm your host, Ben. You've been watching Framework Fortune.